On September 13th, the latest edition of the U.S. CPI report was released and showed an alarming increase in inflation. Most notably, month over month, excluding food and energy, was up 0.6%, and the headline year over year was up 8.3%. Treasury yields moved sharply higher as expectations for Fed aggressiveness rose. The two-year U.S. Treasury yield moved swiftly from 3.5% up to 3.7%, and 10-year yields moved from 3.3% to above 3.4%. Of course, the two-year yield reflected the belief that the Fed will likely stay the course on raising short-end rates, and that could explain why those rates outperformed the 10-year Treasury yield. The CME FedWatch tool went from pricing in a 0% chance of a 100 basis point hike at the September 21st FOMC meeting to now giving that a 22% probability. Meanwhile, long-end rates now have to deal with the belief that inflation is not abating and also that the Fed will stay the course in their intended quantitative tightening program that's set to increase in September to allow $95 billion to run off per month, up from $47.5 billion scheduled from June through August. If a trader believes that 10-year Treasury yields could continue to rise, they could express that by buying the September micro 10-year Treasury yield futures contract at 3.45 and targeting a move to the psychological level of 4.00. A stop for this trade could be placed below at 3.15. This trade could make $550 if your target is reached and risks $300 if you're stopped out at your level. Now, if a trader believes that the 10-year Treasury yields could move lower from here, they could express that by selling the September micro 10-year Treasury yield futures contract at 3.45 and targeting a move to 3.00. A stop for this trade could be placed above at 3.70. This trade could make $450 if your target is reached and risks $250 if you're stopped out of your level.